everyone, welcome back to the Vinance Vault. It's me, V, your dedicated ACCA Chartered Accountant with a flair for making money habits, life habits. So, as an accountant, one of the questions I get asked is about tax minimization. I mean, who doesn't want to make the big bucks without handing too much over to HMRC? So yes, I said it, the unspeakable word tax. And that's why I made this short practical video to give you a quick, easy and legal way to pay less tax using your pension. I always come true for you guys. So let's dive right in. Now, before we jump into the step-by-step examples, let me quickly explain something important. The pension annual allowance. Right now, you can contribute up to $60,000 a year to your pension and still get tax relief. And if you haven't used all of that allowance in the past, the rules actually allow you carry forward unused allowances from the last 3 years. That means depending on your circumstances, you could make a much bigger contribution this year and still claim tax relief. Pretty powerful, right? Most people don't even know this exists. Now let's get straight into the quick explanations. Your pension contribution reduces your taxable income, which means you pay less income tax today and you build your retirement pot at the same time. In short, money that would otherwise go to HMRC gets redirected into your pension instead. Now here's a quick reminder of the UK tax bands for the 2025/26 tax year. 0% on income up to 12,570. 20% on income up to 5270, and then 40% on income between 5270 and 125,140. Above that, it's 45%. Now, there are two common ways relief is applied. The first is relief at source, where your pension provider claims basic rate relief at 20% and adds it to your pot. If you pay a higher rate, you claim the extra via a self-assessment. The second is net pay arrangement via payroll. Your pension contribution is deducted before tax, so you automatically get full relief at your marginal rate. Now, here's a side note. The exact process depends on your employer/pension scheme. Now let's get things started with our relatable examples. For our first example, we'll be referring back to Sarah from my previous video, who was a low-income earner but has now received a salary boost to $30,000. We'd assume a pension contribution of $2,000. Our taxable income before contribution would be the first $12,570 at 0% and the next $17,430 at 20%. This will bring her total tax to $3,486. Now, assuming she makes a $2,000 pension contribution, her new taxable income would be $15,430, which will be taxed at 20%. This will bring her new tax to $3,086. Now her effective tax rate would be $400, bringing her new cost of contributing $2,000 to $1,600. Now, big takeaway here is that Sarah's pension gets $2,000 but effectively costs her just $1,600 after tax relief. For our next example, we have Ken, a higher rate taxpayer who earns $70,000. Would assume a gross pension contribution of $5,000. His taxable income before contribution would be $57,430, with the first $12,570 at 0% and the next $37,700 at 20%. Remaining $19,730 will be charged at 40% to bring his total tax before contribution to $15,432. Now, assuming the pension contribution of $5,000, the new taxable income will be $52,430, with the first $12,570 at 0% and the next $37,700 at 20%, with the remaining $14,730 at 40%, bringing the total after-tax contribution to $13,432. Now this will create a tax savings of 2,000 with a net cost of contributing equal to 3,000. Now, key takeaway here is that for a higher rate taxpayer, each 1,000 contributed can save 400 in tax. Very powerful, right? For our next example, we're meeting Dot from our previous video who had a salary step down from 60k to 52k. Yeah, we did say our examples would be pretty realistic. And this example also aims to show the band crossover effect. Now, the taxable income before contribution would be 39,430 with the first 12,570 at 0% and the next 37,700 at 20%. The remaining 1,730 will be taxed at 40% to bring the total tax before pension to 8,232. Now, assuming a pension contribution of 2,000, new taxable income will be 37,430, all of which fall within the basic rate band and therefore will be taxed at 20%, which will bring the total tax to 7,486. To lead to total tax savings of 746 and a net contribution cost of 1,254. Now, Dot avoided higher rate tax on that 1,730 slice. The contribution didn't just get relief, it kept Dot in the lower band, which gives an extra benefit beyond the marginal rate math. Now, I'm not going to go too deep into that as that's some deep level accounting. For next example, we have Tripped, an additional rate taxpayer earning 160k who assumed a pension contribution of 10k. Now, the total taxable income would be 160k as income is above 125, 140 and therefore beyond the personal allowance threshold. This will mean the first 50 to 70 will be taxed at 20%, the next 74,870 at 40%, and the remaining 34,860 at 45%, leaving a total tax of 55,689. Now, with a 10k contribution, the new taxable income will be 150k with the first 50 to 70 at 20%, the next 74,870 at 40%, and the remaining 24,860 at 45% to bring the total tax to 51,189. Now, this would lead to a tax savings of 4,500 with a net contribution cost of 5,500. Now, a big takeaway here is that for additional rate taxpayers, pension contributions give the largest marginal tax relief at 45%, which makes pensions a very effective tax planning tool. Let's dive into some key rules and practical tips. First, your annual allowance is 60,000 for the 2025-26 tax year, and higher earners may have tapering rules. Check the annual allowance limits if you earn a lot. You can normally contribute up to 100% of your earnings and get tax relief, which is subject to the annual allowance. Which relief method your scheme uses matters. If your scheme uses relief at source and you're a higher rate taxpayer, you may need to claim extra relief via a self-assessment. Always check employer rules. These can change the math and are often more tax efficient. If your salary is close to a band threshold, a modest pension top-up can produce disproportionately large benefits, as we saw in our last example. For our last example, we have Chen from my previous video who was earning 140k and has now gotten a buffer up to 180. This year, Chen would like to contribute a total of 100k to her pension. Normally, the maximum annual allowance for the 25-26 tax year is 60k. Anything above this in theory wouldn't get tax relief. But Chen hasn't used all of the pension allowance in the past 3 years, which means she can carry forward those unused amounts. So her total available allowance for the tax year is the 60k plus the carry forward 40k, giving a total of 100k. Now, without a pension contribution, the total 180k will be taxable with the first 50 to 70 at 20%, the next 74,870 at 40%, and the remaining 54,860 at 45%, leaving a total tax of 64,689. If she decides to contribute 100k into the pension, her new taxable income will be 67,430, with the first 37,700 at 20% and the remaining 29,730 at 40%, leaving a total tax of 19,432. Now this will bring about tax savings of 45,257 with the net cost of tax at 54,743. Alright, so we've seen how pension contributions reduce tax for basic, higher and additional rate taxpayers. But here's where it gets even more interesting. The carry forward rule. Now look at that. Using carry forward, Shan put 100k into her pension, but it only cost her about 54k after tax relief. That's a massive saving if you ask me. So if you're a high earner and haven't used your full pension allowance in the last 3 years, definitely look into carry forward. It can be one of the most effective ways to slash your tax bill while boosting your retirement fund. So that's the trick, guys. Pensions are not just about retirement. They're a smart legal way to reduce the tax you pay now and grow your future wealth. If you want, I can drop a downloadable cheat sheet with these examples and a calculator you can edit with your numbers. If you learned something today, hit the like button, subscribe, and drop a comment. Tell me which example matched your situation, or give me your salary and desired contribution, and I'll show you the math in the comments. I'll be replying to as many of you as I can. Now, let's unlock the power of finance, one vote at a time.